Welcome to the Slow Money Club podcast, the show giving you realistic ways of attaining financial freedom. We share get-rich slow strategies to help you go from employee to entrepreneur and turn your dreams into income streams. Now here's your host, Kwesi.
Hello. And thank you for joining me today on another episode of the Slow Money podcast. Now, today, I'm delighted to be joined by someone who is quite impressive to me personally in terms of what I see him doing in property, in the world of property. He's an expert in finance, specifically sort of development finance, alternative finance, and not the type of finance that you get from your average broker. So I'm really looking forward to this conversation. And so I would love to introduce you guys to Piragash from Totum Finance. Hey, Piragash.
Hey, Kwesi, how's it going?
It's going good. And all the better for speaking to you, my friend. How's it going?
Yeah, good. I'm excited to be seeing where this podcast, our little chat, goes today.
Yeah, you and me both. So I guess where it goes, before we get there, let's start at the beginning maybe. And before you were kind of this financial whiz kid in property, sorting out all of this finance for developers, what were you doing and what's your background? What brought you into the finance world?
I think, like most people who get into finance, it's not necessarily a dream when you're a young kid. I still remember the first thing, I remember this specifically in order. 5 years old, I wanted to be Superman.
Oh, cool.
6 years old.
Me too.
Well, to be fair, Kwesi, in your case,
I'm still far away.
I think you're pretty much there, aren't you?
I wish.
And then I think I wanted to be in the police or something. I think at around 6 or 7, maybe sort of taking that Superman thing onto a more realistic area. Yeah. Then realizing, of course, that I probably couldn't manage anything in terms of crowd trouble. We actually grew up in East London, just behind West Ham's football ground.
So wait, hold on one second.
You know, apologies to any West Ham football listeners.
Wait, does that mean that you're a West Ham fan, just to clarify?
Actually, no.
Yay, okay.
No. Oddly enough, I support Middlesbrough because I was born there. My parents came over, or my dad first came over in the late 70s. He was already a civil engineer, and he had to do a 1-year conversion course, and he did it up in Middlesbrough, which I'm sure was a complete shock to him, going from the sun and sand of Sri Lanka to what I'm sure is a beautiful part of the world in England, Middlesbrough.
I'm sure too.
And then they were obviously so bored that I was born a year later. I grew up in and around East London, and I think, you know, one of the things that my parents were both immigrants, and one of the things that they looked to do was to ensure that education was a key component. You know, it was the only way that they could see us move up, I guess, in terms of from, I don't know whether to say we were working class, but certainly we lived in a working class area. And, it was drummed into me very early on that I will be going to university. You know, both my parents had gone to university. And, like everyone else, went to secondary school. I was decent at things like maths, at analytics. I was terrible at art, horrible at languages, to the extent, I remember my parents came on a parents' evening once, and my German teacher said to my parents, let's just get through this GCSE, and he never had to speak German again. So, it was clear that I was sort of more analytical, and I liked the idea, without understanding the area, of getting into accounting, becoming an accountant. And one of the other things I did very early on was I was very focused on getting a job. You know, it was really important to me. Maybe it was something that was drilled into me by my parents, but it wasn't enough to obviously just get an education. And as a result, I specifically chose a sandwich placement year. So a year in industry as part of my degree. and I was fortunate enough to spend it at KPMG.
Nice.
A fantastic company, really, really, in terms of the way it engages employees, puts employees first. For me, at least, my experience was that it was a great place to learn. The only unfortunate thing for me was that I was doing audit, and it was literally the antithesis of what I love to do. But it took a year at a great company to realize that I wanted to add more value than the audit function allowed me to do it.
Yeah.
And having followed that year, I then looked around a little bit more, and I looked at banking as a way in. And I applied to lots of banks, and did all the milk round interviews and the group interviews, which are, let's face it, absolutely horrendous.
Yeah.
Where you need to. I remember one bank said to me, "You scored top marks on everything, but we don't think you're a team player." And I just went, "But that's like literally, I am Mr. Team." And they said, "Yeah, but you didn't speak up enough as a team." I was like, "That's because I wanted other people to speak."
Yeah.
So, I did get a lot of coaching around this, and eventually landed up at Lloyd's Bank in their corporate program. And I was fortunate, like all good graduate programs, number one, they make you feel special because you get treated better than everyone else. You get dinner with the CEO, you get to meet all these senior people, and of course you get to bounce around, which is great. For me, I spent 6 months in Birmingham in business banking in an area of the bank that wasn't credit scored. So if there was a difficult case, it would go to this team and they would look at it. And that was my first sort of sit down understanding of credit. And I remember one case, and this is typical how experience helps you. But I was given a case which was I think it was a charity that had very little way to repay this loan that they needed, and it was coming up to Christmas. And the lending manager knew it was difficult for me and sat me down and said, "Right, what decision would you make?" And I just, all the technical analysis showed to me that we shouldn't lend to this charity. But there was that bit around, actually, although they didn't appear to have a regular income, they always paid their debt. So whenever they'd raised debt before, it was the congregation that supported this charity. It was related to a church, I think, at the time, but they would always raise the money because of that kind of level of support. And it was interesting. I also learned some basics about real estate and assets and why it's important, etc. But it was a really good grounding. I then got the opportunity to go to Dubai for a year. And that was great because the branch over there was a microcosm of the rest of the bank. So they had private banking, corporate banking, business banking. They had a head office team. They had retail banking, except it was all under one branch. And I was fortunate enough to jump around and get involved in like really interesting strategic projects. The bank was expanding there at the time. So, whether it was strategic projects around how we could convince the headquarters in London to allow us to invest more. And I learned from some fantastic leaders, some genuine leaders. That's the one thing I think, I'll talk a little bit later about some of the challenges of being in a smaller organization, but I think one of the best things about being in a large organization is there are some amazing people that you can learn from. Now, I know there'll be a lot of people listening right now go, yeah, but there's a lot of crap people too. And I completely agree. And of course, you've got to manage that. But if you can find those leaders, those mentors, those people that are willing to take you aside and learn, it's amazing because these people see such a volume of in my case, credit decisions that they need to make. So it was really great, and there were some fantastic leaders who I saw people who were able to lead, large teams of 50 plus people. And even when maybe we didn't have all the resources, their ability to lead translated into much more than the assets of the business, for example. So anyway, after a year there, I then went to corporate restructuring at Lloyd's. But actually, this was around 2005. So actually, the market was the credit markets were pretty benign. Money was easy, but yet there were still companies that were failing. And that was really interesting because you then, are not looking at issues to do with the economy generally. You're looking at management issues, underlying corporate failures. And that was a massive insight, in terms of how the restructuring process works, how banks look at support in that area. I mean, I was fortunate that I wasn't in the repossession team, so I was definitely in the team. And I know there's been some pretty bad experiences for, listeners and other corporates, post 2007, 2008. But it was, for me, a really good time to see that actually banks can support if they want, and you can imagine this is, coming at a time when money was flowing freely. Some of the loans were given very, very cheaply.
You can imagine.
And I got frustrated in that year because I felt like I'd finally, during my grad program, I'd be able to add a lot of value. But here, there didn't seem to be a lot of value, or not value as far as I could see. Of course, we were adding value, in terms of transactional banking. So after a year, I then moved to structured finance. And I absolutely loved my time there. That was probably sort of back into 2006, I guess I moved there. And first of all, we had international clients. So I was heavily involved in the marine, offshore, oil and gas segments. We were doing limited recourse stuff. So what that means for the client is that we would lend huge sums of money, but often the corporate that would sit behind it, whether it was a Shell, a Total, an ExxonMobil, etc., wouldn't actually give their full guarantee against it. So it was all about, do the contracts work? If there's an asset that's going to be constructed, how are we sure it's going to actually happen? What kind of risks are we taking? And at that time, a lot of construction was happening over in Asia. There was a move away from the Japanese kind of typical shipyards, etc., and things were being built out of China more and more, Vietnam. So it was trying to understand all of these risks. Yet at the same time, you had some great counterparties, but they weren't fully backing this. So you can imagine for the guys at home, it's a bit like going into a JV with a billionaire, but the billionaire saying, "Yeah, but I'm putting in $100,000, but that's all I'm putting in. Yeah, don't expect to come to me for any more money." So it taught me a lot about the contracts, and I had some truly amazing mentors there who probably spent a long time, the first 18 months, shouting at me. And I learned a lot through osmosis, sitting next to the person, which is why I feel in this kind of pandemic times, when you're a young person learning and you're not getting to sit next to the person with the experience, I learned so much from just listening to how somebody did things, looking at a document that they've been working on, and then getting to the printer, getting a copy for myself so I could read through it and understand what was going on. And so I got to do some international travel. We were doing deals in Asia, we were doing deals in Scandinavia, and it was really the making of me, I guess, as a banker. And what I really loved was we were often dealing with companies that were, some of them were listed, but often they sat just below those huge companies, and we were going in with value add situations. We were looking to structure things that genuinely the CFOs used to get excited about because there was a lot of advantage to that. Yeah. So, after that, it then became, now we're entering the 07, 08 phase. The financial crisis was unbelievable. For me at Lloyd's, it was really funny because for so long, 05, 06, 07, Lloyd's was the boring bank. shouldn't be doing, we should be taking more risk. We should be doing more on the corporate side and the wholesale bank side. Everyone's stamping up and down. And we largely stayed away from all of that. And we were doing pretty sensible banking. And we ended up obviously suffering just like all other banks, and then merging with HBOS, which was, again, a real insight. We were given a weekend to review their book and asked to provide feedback. Now, when I say we were asked to review, I'm like the low of the low at this point. But, you're still going in doing a lot of the legwork or the grunt work. But actually, we didn't have enough time. If you're doing one transaction would often take us a month of due diligence, and yet we were being asked to review a book in like a few hours. So the main thing we did was we just kind of looked at it and we were like, oh, we've got the same customers. Great. That must mean we've got pretty similar risk profiles. Great. But actually, when you went underneath it, HBOS definitely had a different risk profile to the bank. But again, that merger taught me a lot about how to put two people together, how different banks can take different views on deals and have a completely different risk appetite. Also, what we found about, again, I learned so much from the guys at the Bank of Scotland, but what it also taught me was that there are that you can have very different risk profiles at different banks, and that has been really useful for my approach as a broker, because it's not my job as a broker to make a credit decision. It's my job as a broker to structure a deal that we think is safe, but ultimately be led by the customer, and to ensure the risk appetite of the developer is aligned with the lender.
Yeah.
And for me, what's super exciting about that, and I hope it's a natural leeway now, is the alternative finance space.
Yeah, that was a really great summary. And I like the places you took it, and just to kind of touch on a few of those points. So,
Sure.
I think you're right. The graduate training programs are awesome. I've always said that I recommend it to people, even if, when I started, actually, my plan was to do graduate training program and to work at different banks so that I could work for myself. You mentioned the thing about having mentors at these companies that you've worked at. One of my favorite books, one of the most popular books, is Rich Dad Poor Dad. But actually, there's a line in there that nobody ever picks up on, where he talks about using the company that you work for as your mentor, learning from their systems, their processes, the experience, and using that. So he in his book, people focus on the entrepreneurship side, but he talks about getting a job to learn about systems and processes and get the mentoring from experience. And I think that's what you kind of touched on, and that's a really powerful thing that I've also used. So really good there. And I think the other thing that you mentioned, which was really interesting, is that you moved around, you bounced around, but the way where you landed and how you found a place that you were naturally comfortable in the structuring space, actually, in particular. So I guess the question I have there is, what made you decide to leave? Why did you decide to move out of that space and become a broker?
So, in effect, so I left banking in 2015. So I actually left Lloyd's in 2010 and joined RBS. So, and after 5 years of restructuring there, I took redundancy. And some of the reasoning around that was that I could see, after 5 years of restructuring, the UK banks found it incredibly difficult to compete with the international banks. Rightly so. The capital costs for the UK banks went up. The interrogation into the models that we used went up. And often what that meant was that the amount of capital that we had to put aside to these kinds of deals went up, which, for anyone at home, all that means is that we got more expensive. But we didn't just get, 5 bips or 10 bips more expensive. Over that period, we became, 50% more expensive than the international banks. And so very quickly, what that meant for me was that I knew that if we weren't competing and we weren't growing, what possibly, I'd done almost 7 years of restructuring by that point. And I wanted to get back to being on the front foot, being creative, and looking at positive situations rather than always sort of managing difficult ones. That's not. I mean, I don't mind looking at that stuff, but definitely my joy, where my energy is definitely, looking at creative ideas, new ways of doing things. And so when I took that decision to leave, at first it was just because it was almost out of necessity. But the second part, in terms of becoming a broker, that was a very different process. So, the first thing I did was I tried to look for another job. And as I looked around, there was one particular recruiter who really helped me. And they kind of said, you're applying for these general banking jobs, but you're really specialist in a certain part of the market, which isn't particularly hiring jobs right now. And if you're a large organization, let's say HSBC or Barclays, and you've got to take a chance on me in a role that I hadn't been doing before, why not try somebody else in the organization internally amongst their other 70,000 people and then taking a chance on me? And that was really, really helpful, although it was hard to hear because I felt like I had huge amounts of value to add. It meant that I sort of said, okay, I get it. So now let's put that aside. What am I going to do? And I'd always wanted to run my own business, but probably, when you have a salary and you have a career path, it's sometimes very difficult to make that step out, even if you've always wanted to, because at that point I was married, I had 2 young children, and you think, oh, can I do this now? So the pot of redundancy money that I had helped me kind of think, okay, if I'm going to do this, I'm going to do it now. And then the next thing was, what do I do? And a friend of mine was in domiciliary care, and I spent a few days with him and talked about his business, etc. And I realized how hard that business was. So I looked at the macroeconomics, right, and I thought, oh, exciting, right? Everyone's getting older, everyone's getting sicker. It must make sense to go into this business. And hats off to the people that make it work. But for me, it was, unfortunately, we haven't yet really worked out as a society how to pay for that sector properly.
Yeah.
So you end up almost worrying about keeping the cost of staff down as low as possible, and charging as much as possible to the clients who can barely afford it or have to give up their homes in order to afford it. And I just thought, no, I can't do this. And I looked into some other franchises, and in the end, I concluded that having spent 15 odd years in banking, that I needed to utilize some of that experience, because why completely change? And so I met up with a company in Yorkshire called White Rose Finance, and they initially we were talking about me being a rep for them. That wasn't so exciting. And then they said, well, why don't you join our AR program? You create your own brand, everything else, but we will support you with the compliance. And although, you've been in banking, you don't really know how broking works. And that's right. How much do I get paid? When do I get paid? And, how do we engage with clients? How do we keep compliant with the FCA? What's regulated, what's unregulated in this space? And so they were a huge help at that time to really help me. And I was one of those people, I was pretty convinced that I wanted to go out on my own at some point. So I was the guy that would, in those first 6 months, I must have been on the phone to them constantly going, but why do we do this? And how do we do that? And why is it that this bank will say yes, and this bank has this process, but doesn't allow this, and this doesn't make sense? And what, just like, because these guys were the experts in it, and it was brilliant because they sometimes begrudgingly spent a long time explaining different things. And then probably about a year later, we went directly authorised. And what I would say to anyone is that those first 9 months were brutal for me. I was, bushy-eyed and, hugely optimistic about this market that I was entering into, and I'd spent ages designing my logo, and my website was there. Yeah. My business cards were printed. It doesn't, honestly not so important, but you feel like when you've gone from a corporate environment where everything's done for you, you feel like, oh, those things are so important.
Yeah.
And so I got all those things done, and I started marching, and I started saying, let's do this deal and let's do that deal. And it was hard because why? I'd gone from a completely different competitive environment. It wasn't like I was doing SME developers. I was doing listed companies on offshore deals, and I moved from that to doing this segment, which is very much doing SMEs now. I love working with SMEs. I love the fact that this is their business, their heart and soul. It matters to their family, it matters to their kids, it matters. Everything matters about the business, and often they wear the business on their sleeve, which is why I love working in this segment. But to start with, of course, I had zero brand. Despite my shiny business card, they were like, Totum. What is that even? Totum, okay. And I've never seen you before, and no one knows you. And so it was the hard graft. It was doing the hard yards, and it was just me. It was turning up every day, working from 6 until 6, or even later, not eating sometimes, just working. And I lent heavily on my wife, to look after the kids, to feed me, to make sure I had a shower sometimes, in order to. And then suddenly, after 9 months, it turned. In those last 3 months, we made more than enough to make the business worthwhile. And what I would say for my personal journey is, during that time, I've always been, what banking taught me is always diversify, always have a backup plan, always keep cash flow going. So despite this redundancy, what I did was I trained as a security guard, just in case, right? I needed to have a job. So I did the training, and it was quite funny. On my training course, there was like an ex-police officer, ex-army officer, people who were going to do bounds, a huge guys, and it was me. And I just thought I'd work in a hotel reception or do something like that. And I got the qualification. I actually got some handcuff training, so I would know how to put handcuffs on something. I've forgotten it now, but and anyway, so then I started applying for jobs, and no one would give me a job. One guy really, well, the reason I don't want to give you a job is your English is way too good. The guys are kind of with your own communities, and you won't like it. And I went, I just want a backup job. And I actually even, I tell this story sometimes. I ended up doing one job where I was packing vegetables, literally on a conveyor belt, taking it, putting it in a box. And I did that not because at that moment we were desperate, but I just thought in my head, look, you just got to keep cash flow coming in. Even if it's small, it doesn't matter. I didn't want to go and do another job because my main job was making Totum work. But when I looked at that, that was pretty depressing. It was depressing because when I looked at the other people that were doing this job, and I thought, wow, how fortunate I am about the jobs that I have done. And my wife sat me down, and I credit this to her, and she said, stop focusing on the plan B, right? Because you have something that works. You've proved it at a corporate level. Go all in. Now, that when I say go all in, that doesn't mean that, I was going to take stupid risks, but it meant, look, just give everything to this and not have all these other side hustles or jobs or whatever. And in doing that, whether it was just timing or whatever it was, but within a month, I got my first deal, and my second deal, my third deal. And actually, one of the funniest things is my first 2 or 3 deals were all people that had gone to school with me, that had their own businesses and were, and I think this is amazing, and I think this is really important, is that entrepreneurs themselves who didn't have to use me, but almost used me because they were like, we know you're good, but we'd like to give you that chance as well. As entrepreneurs ourselves, we want to give you, we need some financing, and we'd like to use you to give you that start. And it made such a difference because it gave me the cash flow for the next 6 to 9 months. And then after that, we started positioning the brand better in terms of not just turning up to networking events, but speaking at networking events. And I started to get my groove, which was actually, what does Totum bring that's different to everybody else or the majority of our competitors? And that's that we look at it from the corporate perspective. The the same level of advice that we give to, or I used to give to a corporate or a listed corporate, I give to the SME in terms of risk. And my motto is, I would rather tell you not to do this deal so that we can remember that and do our sixth deal together, than just do our first deal and then that transaction goes wrong. Because I know how important it is to SMEs. So hopefully that sort of, I'm going on now, but hopefully that sort of answers your question.
It does. And I think one of the points you made there, which is really powerful, when you started out, everybody starts out, even from where you came from, taking redundancy, voluntary redundancy. But when you get into that situation, you being willing to do whatever it takes to keep the cash flow coming in is really powerful. I think most people, not most people, but a lot of people might wait until the situation becomes really desperate and then think, oh, what can I do? But understanding early on that even if you've got something coming in, it tides you over, and that kind of effect. So I think that's something that I don't want to get lost in terms of what you were saying. But also, it's great, the idea of building your own brand, right? Taking something either as a franchise and then becoming, authorized yourself and building it from where you are, the 9 months of struggle to the 3 months. It's a really good point there too, actually, that most businesses fail in less than 12 months, but those that go on past 12 months actually do really well. And so this is the thing, if you had stopped after 6 months and focused on stacking boxes, I don't know where that would have taken you, but those extra months, clearly.
I'd have been the world's best box stacker, that's all I could say.
And I don't doubt that for 1 minute. But that's really good. So, okay, now, where I really want to talk about is, given your experience now, everything that you've done, everything that you know, how do you see the world of finance developing going forward? Because you mentioned some really key timelines there. 2005 to 2007 is really important because that was a totally different market. I always say, actually, people like you lived the glory years, because I didn't start my career until after that point. My first month in banking, Lehman Brothers went bust. Northern Rock, a few weeks later, was in trouble, and then the global financial crisis came, and this was all within 3 months of me coming into banking. So
I now know why you spoiled it for the rest of us.
Because you guys ate all the cream, and I was like, what happened? All these people who got the big people. I came into banking, people like, yeah, big bonuses. Wait, no bonuses. They took all the bonuses already. There's nothing left. And so, yeah, but on point, I think the key thing I want to understand is, from that position, not necessarily from the corporate, but from the financial market perspective, from the type of products on the market, how the products have evolved, but more importantly, post-pandemic, right? We're in this COVID environment where things have changed, and we're in this new environment, and there's clearly pros and cons. So I guess from your perspective, what do you see as the changes that have happened?
I think the major point to make is that this current crisis, the pandemic, has not been a financial-led crisis. It's also, because of the fact that we do a lot of real estate, it's also not been a property-led crisis. So, 07, 08, it was, the financial market stopped. We had runs on banks. If we can even remember back then, runs on banks. People thought that their high street banks would not survive the day and their savings would disappear. So, you mentioned
that.
Pandemic,
look, that week. I remember walking to work. I'm fresh out of university. I don't really know much about finance or banking or the world in general, apart from where the nearest Revolution bar is. But I'm walking to work in a suit, and I'm a grown up at this point because I wear a suit to work, and there's people standing on the street. I start work at this time. I think I was working at Goldman Sachs at the time, yeah. And there's people standing on the street before the banks open, and I had no idea what was going on. And this is, I look back to that time, and it's just unbelievable to even fathom.
Yeah. So building on from that, the pandemic has been it's been a human lesson. It's been a social lesson on so many different levels. And of course, it's hit businesses. Of course, it's hit firms that were perhaps, operating in a weak environment, the lesson of thin margins and corporate losses, didn't survive post that period. I think looking towards, companies like Topshop, Sir Philip Green's empire, didn't survive because actually I don't think it was part of Philip Green's mission to constantly change and evolve and invest hugely. Because to be fair, he made huge, as an outsider looking in, I've never been involved in his companies, but as an outsider looking in, he made a huge amount of money from leverage. But he got those dividends out, he made that money, and he created some fantastic businesses. But the reason the reason he didn't reinvest in the business was, guess what? His skin in the game was now close to zero.
Exactly.
Because he got his exit. So sometimes I get clients in the SME space say, oh, but look, there's huge amounts of security in this, or there's going to be lots of profit. Why is the bank focused on my skin in the game? Well, because of this. Because the master of any business is the entrepreneur. This only survives because the property developer, the property investor, the businessman that drives it forward, takes it through hard times. And we can see if someone with as many advisors as Sir Philip Green can actually take their foot off and not focus on it, we see a failure. And of course, the worst thing that can happen in these kinds of environments is a bank taking over, because a bank is not built to be entrepreneurial. And actually, that's one of the things I'd like to get onto next. But so, in terms of post-pandemic, this has been business, there's been trading businesses, there's been certain sectors which have been massively affected. But our banks are safer than ever, I would assume. We've ring-fenced capital. We've got the government securing elements of cash deposits for people. And so actually the banking system is probably stronger. But at the same time, the impact of all of those things in order to make the bank safer has meant, and people will feel this, their high street traditional banks have actually stepped away from supporting SMEs.
Yeah.
And they've stepped away from SMEs, not because banks don't like SMEs, but all of the data tells you and feeds into the capital models that if you lend to an SME, it's far riskier than lending 100 million to a strong corporate is infinitely less risky than lending 1 million to 100 thinly capitalized SMEs.
Yeah.
And that is the crux of it.
That's it.
So what's the result then? And this is what I love about being a broker in this market, is that we've got now, 150, 200 alternative types of lenders. I should also say that there's a bunch of challenger banks that have come in that are operating and definitely serving the SME community. But also we're getting pure debt funds. We're getting peer-to-peer lenders. We're getting equity peer-to-peer. We're getting family offices. And it's not all upside, because the reason why everybody's falling over themselves to get into this market is, number one, typically there is an element of security there. And number two is that the rates that are being charged are way higher than the banks used to charge and are so attractive that, you look at where bridging was in 2010, you might have 1% a month, you have arrangement fees on top of that, and it might even be higher. So you're charging the client between 12 and 15% all in.
Mm-hmm.
I mean, if you went to any debt fund and said, what I love about that is if you went to Goldman Sachs and said, by the way, what our business is we lend 65% loan to value on security, which is everyday housing, which is incredibly liquid as a illiquid asset is, and we're going to charge 15% return on that. Like, wow, we've got new masters of the universe, right? Without it being that complex. And so because of that, what happens is you've constantly got new entrants. And what we've seen recently, in the very recent past with the equity markets, is when the equity markets became very difficult, when bond yields turned negative, a lot of equity money started to pour into secured debt because they saw it as way less risky, but yet still provide good returns. So that's what underpins the market. But that's the sort of macro view. The micro is that it's brought also not just a volume of 200 lenders, it's brought a risk profile of 200 lenders. Because what's really interesting about this set of lenders is that not everyone has come from a banking background.
Yeah.
There are people who are pure property people. There are people who are just wealthy from other asset types and who take a different risk profile. They'll maybe do 100% of the debt because they want an upside or a warrant for the profits, or they'll take more leverage, or they prefer to take a mezzanine slice, or whatever it is. And so for someone like me, I love it because the structuring opportunities are increased because it's not just all vanilla products. But also what I really love is that the conversations we can have with lenders are very different to the traditional bank, which has its credit policy. Now, having said all of this, I don't subscribe to the model that the banks don't know what they're doing. The banks are, their business models are broken. Because why? Well, the reason why they don't lend is because they have the data to back up the fact that these are risky loans. So when an individual, for example, through peer-to-peer, steps away from putting a deposit in their bank and that money's lent out by the bank, now they're doing it directly. Well, yes, one of the issues is because we all live in a house, we all think we understand real estate.
Yeah.
And maybe we do to some degree.
More
but
than
we
stocks.
don't on a level. We don't ask.
Yeah, we understand it more than we understand stocks or crypto. I can give it that much.
Yeah, exactly, right. But there are still nuances. There's a reason why you bring in credit underwriters who've had years and years of experience, who've seen good times and bad times, and we are slowly seeing that evolve. And I think the financial crisis certainly saw. And the other thing, of course, is that the thing about all financial institutions is when you start with a clean book, you can go and do every type of deal, and you get excited and you're optimistic and all of those things. But as soon as you start having a couple of bad deals, now what happens?
Yeah.
The same person who used to underwrite the good deals is also spending half their time looking at bad deals. Suddenly they look at a deal and go, yeah, but their experience isn't quite what we would like.
Yeah.
And they're asking that question because the bad deal has gone wrong. They've asked the question of the developer or the property investor, well, now that this structural problem's turned up, what are you going to do? Oh, I don't know.
Yeah.
Let's create a report, or let's pause things, or there's a shareholder dispute and everything stops. And so it's natural then, and that's what we've seen. I always think that when someone's new into the market, it's an interesting time because they're shiny, they're new, and often their risk profile is at its highest. And then as you get a corporate that has more experience, more intellectual capital has been built up, then they start taking a slightly different position in the market, perhaps a more sustainable one. But ultimately for us, it's always understanding who all those people sit, where they sit, and also understanding that, of course, things change. You can't expect a lender to always be the same because things change. But that's kind of why I love it. I love this market.
Such a really good synopsis you've just given of how the whole thing works and how the whole thing hangs together, because a lot of people don't understand or appreciate what you've just described to us, because they look at banks and they have a certain perception of the bank, or they think their deal looks good, so the bank should be lending, or think someone else might lend. So why isn't the bank lending? But as you've just described, it's all about risk management. And actually another element really important you touched on, which is the back book, right? Because it's about how that back book not only looks and is shaped, but how it's performed, which shapes your future decisions. So you're not going to replicate the mistakes you made in your back book.
Completely. And I think the other thing to add into that would be, how these alternative lenders are funded. So the really interesting thing is a lot of the high street banks fund alternative lenders. Because guess what? They take if the alternative lenders may be doing 65% loan to value, the high street banks funding them at 55% loan to value and getting all the security and even cheaper and all those things and getting a great return than they would normally, all of those things. But what happens now is, and this is a really interesting point, your individual loan, your individual relationship, I would argue, is potentially less important than the funding line. Mm-hmm. Because if the funding line disappears or you disappear, which has the most impact to their business?
Yeah.
Arguably, it's the funding line. And so, again, it's understanding how these lenders are funded. And fortunately, it's a question we ask more and more. And we're also glad the borrowers ask that question more and more. It's understanding. So although we've talked about a lot of complexities, I still come from a very simple, stupid way of looking at things, right? Because I'm not doing complex derivatives or derivatives on derivatives or anything like that. We're ultimately talking about how do we get paid? And if we don't get paid, how do we ensure we don't create a loss? I mean, really, that's it. Constantly ask those questions, and actually, even for the complex derivatives, we should be asking those same three questions.
Such a great point. No, look, you touched on some. Sorry. You finish your point.
No, and so when we're looking at these questions, it's as a borrower. Sometimes we're so focused on getting the loan, we should also ask the question: what is the lender getting out of this? Why are they doing this loan? For what purpose? And why do they want this relationship? And what does that mean for me going forward? And I think that starts to allow you to become a better business person because you start becoming more strategic about your funding choice. I mean, look, we all understand that sometimes you just need a loan to make your deal work, and it's whoever will give you that loan. But just because that's the case, don't forget to ask those other questions. It's okay to say, well, I am really desperate for this loan and there's only one lender in the whole market that will lend me this money. Okay. That's okay if you still want to make that choice. But the realization is your risk profile is so high that it means that if that lender was to ever walk away, you've got nowhere else to go if you need a refinance. It means that if there's any other type of problem, again, with that lender, if they say jump, you've got to jump because you don't have that secondary option. So I think it's really, really important for a borrower to consider that, or an entrepreneur. And by the way, it's okay having considered that to say, yes, it's true that no other lender will borrow to me, but it's a means to an end. As a result of doing this deal, which I appreciate is risky, and the downside risks are X, Y, and Z. I'm willing to accept X and Y. Z, I'm not willing to lose my house. So therefore, I've maybe capped my personal guarantee. And I'm therefore comfortable with it in order to do this deal, because what it does is it gives me a lot of upside in terms of making me more marketable in the future.
Great point. I want to go back to something that you mentioned earlier. The fact that a lot of people, when they go into a deal, are so interested in what they're going to get out of the deal or what the profits are. They're not focused on where they're getting funding from. But the point you made, more importantly, is where their funders' funding is coming from. It's such a great point I want to touch on, because that affects the risk profile of the lender, in the sense that if you get into financial difficulties of any sort, it affects how quickly and readily they'll be to repossess that asset. For example, if they're under pressure from themselves, then they're going to be more likely to repossess. If you go to a high street bank, even if it's a non-regulated commercial loan, the probability of repossession is still going to be relatively lower because of their general risk profile, reputational risk that they're willing to undergo and things like that. So that's such an important point, in that it's not just about who you're getting the money from because they'll give it to you today, but it's about if something goes wrong, what would they then do? Just wanted to draw down on that point.
No, I agree, and I would add that I think it's a really good point that you make around reputational risk, because if you're a private lender lending your own money what's more important to you?
The money.
Your reputation or not losing money?
Yeah, they don't care about the reputation as much. The money is all they care about.
Yeah, and look, to some degree, that's fair, right? It's their money, it's their hard-earned money. So, but it's being open to that. It's understanding how you do that. And then it goes back to, even if that situation where you end up with a private lender and that's the only one that would lend to you, really, and understanding that it's their own money that they're lending, what I would be doing is setting up a really good comms process so that you constantly are engaged with them. They've taken a bridging loan, and at the end of 9 months or 10 months or 12 months, they have to send you a letter to then engage about what's happened. No, you constantly communicate. You talk about how much you've, because that also helps you legally when you are, going to court and trying to prevent the repossession or whatever it is, because you can say that you've communicated that actually there is a route to success. And, generally most people, I don't think, there is definitely a handful of lenders that may be, lending to own, where they happily repossess you. But most people want to create the lending business, and so they want to work with you. But it's just asking that question and setting up a series of comms so that, and this can sometimes be difficult, for a lot of entrepreneurs, it's often a view that you pop open the champagne bottle when you've taken the loan, when all you've actually done is you've created a big liability.
Exactly.
Nothing to celebrate.
Oh, you know what? This is a conversation. People always say to me, they look from the outside and they see your business and they see properties and they think of how much properties you have and how much it's worth. Whereas I always say to them, in my head, what I see is the liabilities. I see the debt. I see the mortgages that are on those. They might see millions in property, but I see millions in debt. I'm thinking actually there's multi-millions in liabilities here that you need to every month make sure are covered. And but I think this is again a paradigm in terms of how you look at risk.
Definitely.
So I want to ask you this then. In terms of where we are now going forward, so we talked a bit about financial crisis to the pandemic, but how do you see all of what you just described evolving over the next sort of 18 to 24 months?
Again, I'm definitely glass half full type of person, and when I look at what's happening in the fintech space, I think it's super interesting. You and I talked off camera actually around Pingit closing, Barclays closing the Pingit thing, and you should definitely share what you have about what you understand about Pingit. But for me, it's what a sad. I'm sorry. The other thing is NatWest recently closed Esme loans, and I found that to be incredibly sad that these organizations that do have the people that create entrepreneurial elements are unable to drive those separately from the corporate brands, parent corporate brands, such that it's left with startups. However, the positive side of that is you look at things like revenue, you think all of those types of things. And what I see in the fintech space is, payments, operational banking, all of those things are what's driving value in the fintech space at the moment. But what is absolutely coming is the lending side, because as we get more sophisticated, as open banking becomes more sophisticated, as all of these things, as big data becomes more readily available between new incumbents, that's when you'll start to see innovation in this space as well. And that's the bit that I imagine is the next wave, and I think is hugely exciting. What do you think?
As you say, we have these conversations. I think algorithmic lending is going to be really interesting as we proceed, because obviously a lot of the fintechs have the algorithms, a lot of the banks have the data, but it's really about the marriage of those two things, how you marry the amazing AI and ML with the data. The problem is the data for a lot of banks is intellectual property. They're not going to give that up. The problem is for the fintechs, they don't have historical data. They haven't been in the game for long enough to be able to build complex models with data going back more, they can collect that data, but it's not the same. There are banks, Barclays, just for one, I think it's something like 7 and 10 of every pound that's spent in the UK goes through them, whether it's lending, credit cards, corporate banking, commercial banking, retail banking.
Wow.
But across the spectrum. So, just from what the data they see, they can form a great view. Fintechs can't do that. So I think once the algorithms are married with the data, and the other element, I guess, is fintechs will be able to use non-transactional, non-banking data. They'll be able to use things like your social media posts. I spoke to a fintech once actually that said that they could predict when someone's going to go overdrawn based on their use of social media. Yeah. So imagine being able to lend money to someone and use social media as part of the credit scoring or the credit calculation piece. So I think once
what's really interesting about that, Quasi, is like for us, as we're always told, you need credit cards in order to create credit data.
Yes.
Imagine a future where
you
actually have to have an Insta account.
Yeah.
You have to have a Facebook account or a LinkedIn account, or otherwise there's not enough data for them to make decisions.
Yeah, but I put it the other way. So we were told we have to have a credit card in order to be able to have credit history. But now imagine that you don't have to have anything. Everything you have can be used to determine your credit. Whether it's you have a Tesla collects data, big data, pulls in. They can use your journey to help calculate your credit score. You can see that actually on a Thursday night, he drives to the pub every Thursday. And then from there, we see that he posts pictures on social media about X, Y, and Z. And on the back of that, his bank account is overdrawn on a Monday morning. And this happens every fourth Thursday of the month. And it's a pattern. So then they know. I mean, to be honest, more slight segue, but even just the information banks have and own but can't use because of different regulatory purposes, whereas someone like Amazon, Google, because they're not financial, they're non-regulated in that way, can use that data to make predictive analysis. If banks could do that, they could tell you based on your transactional data that, oh, by the way, you're going to go overdrawn on Tuesday, the 23rd, because actually on every Tuesday, the 23rd, if you go to this pub first, then on Tuesday you're overdrawn. So just be careful. And they can tell you that on Thursday. They can't do that just because of regulations and stuff. But that's where I see it going, where we're talking about lending specifically, but a lot of the non-financial data can be used to create a profile of someone that will make a bit better picture than their credit card, right? Because the credit card tells you, your Barclays credit card tells you what you've done with Barclays, but it doesn't tell Barclays what you've spent on with HSBC or any other bank, Lloyds, where they don't have the granular detail apart from what they have within their own subset. But then once you bring in social media, Google searches, Amazon Alexa, voice searches, use of other things, actually you build a really holistic picture of the individual where credit is one element, and then you can actually focus in and say, actually, I can lend, we can get to a point where maybe instead of doing 12, you can lend to someone on a really short-term basis. I will lend you money for your development for 2 months and 3 weeks. Because actually, based on the data that I have, the algorithms that I've pulled in, the phase that you're in the development, what I know about this phase of development, and what you're telling me, I think this is the lowest risk window. You're going to have money coming in here. You're going to be low on cash flow here. We're going to plug the gap here. You're going to pay me back here. And people will be able to make those level of granular assessments. But this is, as I say, conditional on big data, AI, and actually what you mentioned as well, which is the whole API and open banking and the collaboration between financial institutions. But yeah, that's what I think anyway.
So I love tech, and I love love innovation in this space. But as an old school banker that would review a case, I still struggle with the idea that the data can be big enough and it can provide a better analysis of the situation than an individual. I know it's something I need to get over, but nonetheless, right? But
Yeah.
Nonetheless, it is something that I struggle with. And the only caveat I would add is that, when you go back to 07, 08, is that you can have, the algorithm to some degree is only as good as the person coding it.
Yeah, that's what I was about to say.
When you also get, the beauty of individual markets is that you get less institutional bias. And, the thing that happened in 07, 08, to some degree, was everyone believing the credit rating agencies in terms of how they effectively underwrote, these single mono insurers.
Yeah.
And, I can see a similar thing with algos where you kind of get to a point where you're like, yeah, the risk is fine. And then on the back of that, individuals are making decisions without really appreciating the normal distribution curve on that analysis, and missing the common sense picture, which is actually, okay, yes, the data on this is there, but looking at this from a common sense perspective, there is a sort of a endemic risk that's put at the heart of the system because everyone believes the same thing. Which always gets to a dangerous position, I think.
Algorithmic bias is, I think, what you're referring to, and systematic bias in data. And these are the key risks, I guess, from that future state that I described. And then actually we might have a lot of the inherent biases that are already within our society transposed into this algorithm. It might even, like now, when you have things like credit scoring, there are known biases around things like postcode. If it doesn't matter I might be a banker, investment banker, I might even earn good money, who knows? But if I live in a certain postcode, it would be much more harder for me to get credit. And I remember my mum always said, I grew up on a council estate in northwest London, and now my parents live in Mill Hill, which is definitely not a council estate. And my mum always says one of the reasons she wanted to make that transition is because she felt, right or wrongly, that we wouldn't have the career opportunities if we stayed in that postcode. She was like, if somebody sees that on your job application, they're just going to put it in a bin. So that's, the biases of people. We know that exists in even credit scoring. And then once you take that to a much more macro level, or much more important decision-making level, what does that mean? So those are things that we have to be very, very mindful of. And I think the other point that you made, I don't think that there's a separation. There's a great book called Rise of the Robots, actually, and it talks a lot about what you were just saying. I don't necessarily think it's about you getting over it. I think it's about understanding where the dovetail starts and ends. I don't think someone like you will ever be replaced. What will happen is that you will spend much more time on the 10% of cases that are really difficult and less straight through and need that. I argue that you will spend 90% of your time on the 10% of things that you currently enjoy. And the machine will do the other 80% or so. And so that's how I see it. I don't really see machines or robots or algorithms replacing people. We're going to have to monitor them. You're going to have someone to build them. You're going to have someone to monitor them. And I guess the final point on this is the example I always use is that when ATMs were invented, automatic teller machines, you would think they're going to be automatic. Tellers thought they would be the end of them and the end of their job. The outcome of that was not less tellers, but more. And so I really foresee that in terms of the machine revolution, is that actually as we introduce more robots and AI, we're going to need more people, not less.
Interesting. If I may, I want to pick up something that that we need to talk about as well when we talk about the future, and something that's really relevant right now, and I've got a relatively passionate view on, which is, these baby new products need support and love and a certain level of understanding. What I mean by that is we've seen in the last couple of weeks a peer-to-peer lender fail, lose money for their investors, and effectively, from what I understand, it's into liquidation. Now, interestingly, I've seen a lot of comments on social media and actually within the highbrow press around the death of peer-to-peer. And, I'm a little bit, I feel like that's a headline because actually there are a bunch of really good peer-to-peer lenders who work very, very hard. And one of the things that have been raised is people making decisions with other people's money is dangerous. Well, hang on a second. You pretty much described every financial institution.
Yeah.
Yes, there's a handful of institutions in the alternative space that use their own money, that the owners put their own money at risk. But if bankers can make this decision, if funds, by the way, can make this decision, don't tell me that all fund managers are putting in a whole bunch of their equity. No, they're getting other people's money and they're playing God with it.
Yeah.
So that's nothing new. And I think when something's as new and you've got people trying to new things, then of course people will fail. Some people will get it wrong. That doesn't mean that everybody in the industry should be seen as the death knell. I think we've got to be very, very careful. Does that mean we should ask questions about the level of regulation? Does that mean we should ask questions about the board makeup or the management makeup of peer-to-peer? Does that ask question around whether platforms should have trustee status when things go wrong? All of these questions are things that should be asked. But I firmly believe that allowing somebody to get the full benefit of helping an SME, that's not a bad thing. And I don't think that in of itself, that mechanism, I don't think is dead. I think that perhaps what we need is better analytics, more support for these peer-to-peer so they can make better lending decisions. But just like banks have made so many mistakes, no one's saying, by the way, let's use taxpayer money to save the peer-to-peer industry, much like we did for the banking industry. Understood, too big to fail. It's been done before. It's been talked about. But with the peer-to-peer, and one of the big things I would say is we are enriched by a diversity of funding options. We're enriched. I actually don't want to go back to a time when there's only 5 lenders. I don't, because I think you're poorly served. And I think leaders within the traditional banking industry, leaders within whether it's more atypical bridging lenders, leaders within peer-to-peer, all need to stand up and to some degree have a level of support, because if we try and kill different parts of the industry, we can also learn from different parts of the industry. And so just going out and saying peer-to-peer is dead, I think is dangerous, because it reduces our diversity, and potentially it also means that retail investors, for example, may not be comfortable enough going and investing in these things. And I think the headline shouldn't be peer-to-peer is dead. It should be peer-to-peer needs to evolve, needs to change in the right way. But I'm not a big fan of some of these kind of negative comments that peer-to-peer is dead.
I can tell, and I think rightly so, though, because you're right. The press in particular have a tendency to be over dramatic when they want to sell papers. But I certainly don't think. I think peer-to-peer is barely started, if you ask me. I think diversification of funding has probably been the biggest thing that's happened since the financial crisis. And, as we've spoken about before as well, I think one of the unintended consequences of the financial crisis is all this diversity in funding, all of this fintechs and all of this stuff, whether it's because of talent that left the finance sector because of redundancies and then moved to become things like brokers to independent people. And, that talent migration, some of that senior execs who left banking, couldn't find jobs, became non-exec directors for startups and fintech, accelerated their growth. So, we're all still learning, and I think it's still such a nascent industry, peer-to-peer in particular, but peer-to-peer, crowdfunding, all of that space. I definitely don't think it's dead. I think it's just starting. And I think, some countries it's more evolved and more advanced than it is in this country, but in this country it's certainly more evolved and advanced than it is in a lot of countries. And yeah, like you say, I see it for the long term. I think it should be supported in every sense, and I full-heartedly support your war cry. But as we begin to wrap up this interview, Piragash, what I want to do is ask you a series of quick-fire questions, and feel free to be as brief as you want with the answer. So my first question, what's the best advice you've ever been given?
I think that one of the best advice I've ever been given is focus on your strengths, not your weaknesses. It's something as a self-critical person, often you're so aware of your weaknesses. And again, this was a previous mentor, and when I saw their career trajectory, they said, you can only improve your weaknesses so far, but your strengths can be game changers.
That's a great one. I don't think anybody's said that one so far, so thanks. Second question, What's the worst advice you've ever been given?
The worst advice I've ever been given is probably something around, I don't know whether this is advice, but it's just a comment, which was, there's no point in innovating.
Wait, what?
There's no point in innovating.
Who said that?
And this, well, it was while I was at a bank.
Okay. I understand now. Makes sense.
Yeah. And it was, it was during the financial crisis. It was a toxic environment. It was difficult for everybody. And my natural inclination is, at the time was, well, look, we're a bank and things are really tough. Let's innovate. Let's find new ways of doing things. Let's, I spent a long time putting different projects together. And the advice that came back was, well, what's the point? What's the point of all of this? It's all very well that you've done some time, but actually, do you want to just go back to checking those boxes? That's what's really important. And I think that was the worst advice that I've probably ever received.
Yeah, it sounds like terrible advice. I wonder, but I think when you touch on as well, when you work in big organizations, there are lots of great people that you can learn from, but there's also lots of terrible people you can learn from. And some of the best things I've learned is what not to do from people. So that's a great example of that. So thank you. Okay, next question. How would you describe, or how would you define the difference between debt and equity?
Very, very simply, without getting into complex technical details, I would simply say debt is about funding situations where there is certainty, and equity is about funding things when there is not certainty, but there is a hope. And, if you find yourself in a situation where you've got a great idea about a new business that you want to do, but you're not sure whether it's going to happen or not, that's equity. If that same situation has a contract associated with it, if you can get the money, that's debt.
Great definition. I like that. Okay, penultimate question for you. What are your top 3 tips on raising finance?
I think the first thing is to be prepared, understand your own project better than anyone else. Number 2 is I always come at a point of view that when I'm presenting my case around funding is, as much as possible, use shock and awe. Shock and awe. Be that good. Be not just a standard, here is my loan sum, here is the term, here is the GDV. Take it to another level. Talk about the demographics. Talk about the absolute need for this type of housing. Talk about your plan A, B, C, D. Take it to another level. If they only ask you 2 questions, respond with 5 answers. That is, for me, as a way of raising funding, whether it's equity or debt, will always get you in the room and will get you further and closer to that funding. And the final piece is never rely on one source of funding. Whether you actually use it or not is different, but never use one source of funding.
It's a great one. That last one is a great one. It's a lesson that I've learned myself the hard way. I wish I asked you that question 6 years ago. But yeah, good. Okay, my final question for you then, Piragash. How can people get in touch with you?
Oh, well, this is the easy bit. I am not on Insta. Don't look for me on Instagram. I am not on Insta. My face is not pretty enough for Insta. So you can get a hold of me on LinkedIn. For our details, totumfinance.com. And, you can get in touch via Facebook or the website.
Yeah, and we'll link to it in the show notes. But you know what? This has been such an awesome conversation, as always. I always enjoy talking to you, but this has been a really great one. I can't thank you enough for sharing your knowledge, for giving us so much detail as well. And, a lot of people, even brokers, I speak to a lot of brokers in the business side, and a lot of brokers don't understand finance. They might understand how to go on a mortgage sourcing tech system and putting some information and then hit the print button to get a mortgage agreement in principle or something like that. They don't understand finance. I highly recommend that if you're going to get someone to sort out your finance for you, get someone who really understands finance, someone like Piragash, who, as you've just heard, is really, really in all of the details. So thank you very much for sharing that with us, and I really appreciate it. Thank you. So we'll see you again soon, I'm sure. I look forward to that. But for now, thank you all for joining us here on the Slow Money Club podcast.
Realistic ways of attaining. We hope you.
Let's do that again.
We hope you enjoyed this episode. If you'd like more information on what you just heard, go to slowmoneyclub.com and join the club. Don't forget to subscribe on Apple Podcasts, Spotify, or whichever app you use.